All right, welcome back to Real Estate Bites, my friends. This is episode number 114. Today, I want to talk about the 50-year mortgage. This is something that's been in the news quite a bit recently. Everybody's got an opinion, but it's important, and it's going to be something that is going to play a role here in our industry, and it needs to be addressed here on Real Estate Bites. But considering that I'm not the mortgage guru, I'm bringing my mortgage guru on. We're going to welcome back to Real Estate Bites my boy Jay Slone from Legacy Home Finance. How you doing, sir?
I'm doing great. How you doing?
Doing good, man.
Thanks for having me, brother.
So, of course, man. Every time you are my go-to when it comes to all things mortgages and finance here in the real estate industry. So, that said, my man, let's start it off, dude. What do you think about this 50-year mortgage that the Trump administration's talking about?
So it's getting mixed reviews out there, and a lot of people are like, yeah, it's great for affordability and anything that can help the American consumer kind of stay up with inflation or make the, buying market more affordable seems like a great idea, right? So I've been doing this for a long time. So we used to have products like this all the time around the collapse time to make things more affordable for people. So just to give you some color, we've had a 40-year interest only, and we had a 50-year with some mortgage companies already back in the day. Now, how these things are priced out, and where I really think it kind of gets off the rails with affordability and people comparing it to, the 30-year fixed, is very simply the longer the term, the higher the interest rate on all mortgages. Okay, that's how it always works. That's why the 15-year is like the best option, right? Because it has the lowest interest rate ideally. Correct. So the longer we go, the more interest you pay, not only monthly, but over the life of the loan. So what I did is I shot a video last week about just showing the differences on a $300,000 loan with only 0.5% higher in interest rate. Okay. That 0.5% only saves people on a $300,000 loan, $99 a month. Okay. So that $99 a month isn't really going to make or break a person's budget anymore. That's like, a lunch or dinner date with your spouse. You know what I mean? So
Sure.
if we're talking about $99.27 over the course of 5 years, so let's even say you stay in the mortgage for 5 years. Let's say we're just doing it to get into the house, to keep affordability where it's at, or to get more affordability. In the course of 5 years, that only saves the consumer $5,956. That's not a lot of money. So what really hurts you in this scenario is that your payments are slightly lower, not a lot lower. So it doesn't open up. It's not like you're saving a few $100s a month, right? But you're giving up equity paid in. So in the course of 5 years, what I showed people in this video that I posted was just the loss of equity that you gain, and the loss of equity is around around 15 grand. You know what I mean?
Mm.
So like, let's say if in the course of 5 years, one versus the other, in a 30-year fixed situation, you're going to pay down your principal by $15,000. In the 50-year example, you're only going to pay your equity position down by $5,900. So you're saving $100 less, right? But then you're giving up all that equity that you're putting into the mortgage every single month. Now, ideally, and this is where it frustrates me, is you always want to see appreciation, right? Like, that's what we buy the home, you buy a home for the future and you hope it appreciates, because not only is it's an investment, as well as just a place to plant your flag for your family, but it's also an investment vehicle, right? But where have we seen there not be appreciation? What type of markets, John? So it's like, if you took out a 50-year fixed, it has to be the best case scenario for it to work, meaning you have appreciation. We're still in this type of market where the appreciation is aggressive, because what happens if you don't pay off any principal and then values go down?
Yeah, you get
You're
underwater.
left with a bet. You get underwater. And then what happens if you're underwater in your house? You're less likely to pay the mortgage. Well, yeah.
Sure.
Well, I mean, you're less likely to pay. And then if things become tight, people want to walk away. And that's where we saw a majority of people walking away in 2008. It wasn't just like, hey, I can't afford my mortgage, but I can't sell it either. So it was like they took out mortgages. And that's really what the financial crisis was all about back in 2008, is it was not only just an affordability thing, but they couldn't get out of stuff. So if you put people and you paint them into a corner like that, they're just going to walk away and go back to renting. And that's what
Mhm.
I'm really fearful of with products coming out like that. So it's like, okay, you don't build any equity, you barely save any money, then what's the point? So I guess that's my take on it is it's a very big risk and it's not much reward for the American consumer.
For sure, man. And I think for most home buyers, right? Most home buyers that you qualify, Jay, right? What they're looking at, they want to make sure that they can swing the monthly payment. It's probably the most
Correct.
important factor for them when they're looking at budgeting for their home. What monthly payment are we comfortable with? Equity is secondary, if not tertiary concern for them. They don't even really consider maintenance costs or what's going to happen to insurance and all that other stuff. What they're worried about, especially a first-time home buyer, we've been paying rent for so much a month for so many years. This fits our lifestyle. Maybe we can do a little bit more than what we're paying right now currently, but that's how they're setting their search parameters by what fits within our monthly budget. And I want to bring this graphic back up and have you run through it a little bit, because ultimately the 50-year mortgage, what they're saying to people is, if we extend your mortgage out additional 20 years, it's going to bring down your monthly payment and make these homes more affordable for you. But I'm going to bring this graphic back up. You sent this to me earlier today, and I want you to kind of run through these calculations for the people who are watching so that they understand how much they are or are not saving per month based upon this
And
new
I thought I was
50-year
being
mortgage.
very generous too. So as we can see, so a 30-year fixed mortgage, let's say the interest rate is 6.25%. On a 50-year mortgage, the interest rate is at least going to be 0.5% higher, which is why I priced out at 6.75. Okay. Now that's being very conservative and fair. It's
And so
most
real
likely
quick
going to
for the
be
people
somewhere.
watching, for the people watching, Jay, 6.25 is right about where we're hovering today, right? So this is
Right. For a
this is
30-year
real.
fixed mortgage. Yes.
Yeah, this is real stuff, real time calculations
Exactly.
that we're looking at here, folks. 6.25 is a 30-year conventional note today, right? And so what Jay is saying is you add 50 basis points on as the premium to go out to a 50-year mortgage. And that is, I mean, that's probably, like you're saying, generous, right? It could be more than that. It could be
Yeah, it's
75
probably
basis
going to be
points.
six,
So,
seven. It could be 6, 7, 5 to 7% because lenders
mhm.
are going to price accurately for risk because it's a 20-year more. It's 20 years extended on the term, right? So
Yep.
yeah, while they're making more interest, they have to price it accordingly. So again, best case scenario, 50 basis points. Okay. So as you can see, if you look at the payment difference, the payment for the 30 years, 1847, and the payment for the 50-year is 1747. So it's less than $100 a month in total savings. It's $99.27 over the course of every single month. So you're saving less than $1,200 a year to take a 20-year step back in term. And what I was referencing, John, is that that's fine. And you know what? If that $100 and that $1,100 a month, if that makes a difference for you buying, then Godspeed. That's great. But I also want to point out, because it's our responsibility to do so as loan officers, is the downside to it. So it's the principal that you're not paying. So just to give you an idea, and if you could just bear with me a second, I'm just going to bring up something here just so I know what I'm talking about that closed out while we were getting going here. So just to give you like an idea of what that looks like per month on, and I know interest isn't like really important to people or principal being paid. They just want something affordable and then they'll worry about it later. But I also think that that's also part of the problem, right? We have to
Well,
make
yeah,
sure that
because
you're covered and you pay down your balance.
the point you're making in number one, in the loss of equity, but also the fact that, how many years are you going to pay on this before you actually have realized any equity in this house?
Exactly my point. So in the 30-year example, while our payment is $99.27 a month higher, the principal paid per month is over $284. Okay.
Mm.
So yep, your payment's $99, but we have $285. Let's just round up a couple pennies going toward principal. In the 50-year example, though, your payment is $99.27, or 27 cents lower per month, but you only have $60.38 coming off your principal. So you're losing $220 a month in principal every single month, and that adds up. So it's essentially an interest only loan. Okay. So that's what I'm trying to point out here, is that while it could be a great product just to get you in the home and save a little bit of money, it's something just like an adjustable rate mortgage or anything else that you would need to get out of almost immediately.
Yeah.
If you plan on
And
staying long term, for sure.
let me interrupt real quick to illustrate a real life application of what Jay's talking about. Many homeowners, when they're, 10, 15 years into their home, they like to exercise a home equity line of credit, a home equity loan, in order to do improvements to the home, or whatever they want to tap into that source of funds for themselves. It's basically tax-free money that you can pull out and you can deploy for whatever it is you want in your life. 10 years into your 30-year mortgage, whatever it might be, certainly it's, the number will be greater in a 15-year mortgage, but 10 years into your 30-year, to the point you're making, you're going to have a decent amount of money to go and grab into, especially if the market has appreciated and your home value has appreciated. But if you have this 50-year mortgage, 10 years in, you have 4 times less to tap into. So that emergency roof repair or whatever it might be that you're looking at doing may be completely unaffordable 10 years into paying on your 50-year mortgage, if that's the option you choose to exercise.
Correct. So here's a prime example. So 10 years from now, like, you'll have 20 years left on a 30-year, your balance would be $252,000. On the 50-year mortgage, you're going to have 30 years left and your balance is $290,000. So in 20 years, you've paid off $10,000 in your principal.
Wild.
So that's not worth the $99, just in my professional opinion. So it'd have to be a very, there would have to be something else going on with that for that product to make sense for my clients, or at least for me.
That sounds a whole lot like Klaus Schwab's "You will own nothing and you'll be happy."
It's funny you bring that up, because I feel like we're being more and more conditioned to do that. So I feel like we're getting into this lease, to where we're being kind of conditioned to just want to lease things and never own them. And that's honestly what this is. This is you always paying interest to the bank. You never really fully owning the property. You never building equity yourself to put back into your home, whether that be listen, I work with a lot of different people. So after a couple of years, a lot of people take out money, not just to put back into the property, but to invest. I just did a loan for a young man. He'd owned his property for almost 10 years. He'd paid it down substantially on purpose, pulled out a home equity line of credit, and he started buying homes with that equity line of credit, fixing them up, flipping them. Very smart kid. And the point is, though, is that he used it he's using it as a vehicle to help him retire and own properties and invest. So there's all these different ways, but this option removes that. It removes the ability to do all of those things, just so you can afford to buy a house, but then do nothing with it outside of just lease it to yourself. That's kind of crazy, to me.
Yeah, I mean, I've exercised that home equity line of credit 5 times now to purchase a rental property and fix it up and refi it and all that kind of stuff. And that's because the equity was available to me.
It's fantastic. It's to consolidate debt. But if you don't have any equity, that's another reason I feel like this is being proposed, is just one less way to pull out something that's not taxed.
Yeah. This is such an important thing for people to understand too. If you go and you take financing and you purchase a home, you move in it, you live in it, you're 100% responsible for its upkeep, et cetera, et cetera. You got to understand, you don't own it. The bank owns it, and you are paying the bank back over the lifetime of this mortgage until you've completely paid it off. And then it becomes yours, and then you own this property, right? And until then, you don't own it. The bank owns it, and you're borrowing that property. You're borrowing from the bank, and it's just the reality of it. And it's a terrible thing, because you could be, 27 years into your 30-year mortgage and have very little of that principal left to pay off. But if something bad happens and, you can't pay, guess what? The bank takes it from you, because the bank owns it, no matter how, they have a lien on it. They own that property. And if you take out a 50-year mortgage, well, the bank owns it for an additional 20 years. And to the point you're making here, you could be halfway through that note and still not have a whole lot of equity in there. And the bank has still got you by the cojones. It's a rough
Right.
situation.
And to me, yeah, and that's what I think. That's why I think it's predatory, Jonathan. So I mean, to be candid, if you can barely afford to make a 50-year mortgage payment, then buying a house is not for you. And for this entire product to work, it all has to be based on best case scenario, unless they know something we don't. And
Mhm.
home prices and things like that are just going to be continue to be more and more less affordable for people. So, getting to things that could work, years ago they did quantitative easing, which you and I kind of briefly discussed, where it's an option where the government will buy assets and invest in them to keep the market artificially low for a certain period of time. Now,
Mhm.
this did lead to some of the inflation that we saw during COVID, but it could be a short-term fix to make ownership affordable for a specific amount of time, where the government would say, okay, we're going to take all the billions that we're just literally putting in other countries and other places and inject it into the market and buy mortgage-backed securities or bonds, right? And then that would greatly lower rates and would allow people to buy. And then also, yes, it would cause a supply and demand thing, which would be another frenzy, but at the same time, it would be a much better fix than a 50-year mortgage, because those rates are permanent, and it would inject a lot of new buyers into the market, and also not a lot of new listings, because people want around the same rate. Like, they'll settle to go from their 3.5 to like a 5.5, but they're not going from 3 to 6. They're just
Right.
not. You know what I mean? So there's so many different things I feel like that they could be doing to help outside of offering a 50-year.
Yeah, and I agree with that. My argument would be I think they should subsidize or at least incentivize in any way they can the construction of more homes, because I think supply is the biggest problem when it comes to affordability. And if they could incentivize more construction, make it easier for builders to build around the country, especially in the larger population centers where you typically find the most restrictive zoning and the most restrictive permitting processes. If those things could be loosened up, relaxed, or at least make it, again, quicker and less expensive. And I think when it comes to subsidization, what you do is
Mhm.
ultimately you subsidize those permitting costs. So the government would pay those communities who don't want to relax their permitting costs and that whole procedure, because it's a source of revenue for them.
Yes.
So instead of putting that on the builders, subsidize it through government and get construction really going. All right. Jay Slone, owner of Legacy Home Finance, you frown on the 50-year mortgage. I frown on the 50-year mortgage. I think across the board, most people do, except for those who are really trying to sell it and make their money from it. So let's move on from
Correct.
there, man. I want you to talk
Yeah,
about
sure.
some new big things that have happened with Legacy Home Finance and what it means to you and yours, man. Tell me about it.
Sure. Well, thank you so much. So we've decided, or I've decided, because I'm owner of the company, to actually get out of our broker model and venture into a partnership with a company that was much like mine. So we partnered with a company named GVC Mortgage out of Indiana. Fantastic family-owned business. They are not public; they are privately owned, and they shared a lot of the same values. So I've been looking for like the last 6 months, and the broker model was fine. Okay. And, at the end of the day, it's what is best for our company and the service that we provide you and the rest of our partners. Okay. And our clients. So there was some things that I just didn't like in the broker model. While it's great for business, the client facing side and the closing side had its problems. Okay. Some of those problems were easily remedied with the partnership. A lot of overpaying and overcharging on the broker model was remedied by partnering with GVC Mortgage. But more importantly, we shared, after me, interviewing dozens of companies, because I felt like getting back into retail was the way to go for my company. They absolutely won us over, because they started off as a broker over 30 years ago, and then developed and became a correspondent, and they're now a very large retail lender. But it took years to get there, and they're the most down to earth people I've ever met. They're great. It's family owned and operated. I could literally pick up the phone right now and call the CEO on Good Friday and get, you know what I mean, and on Black Friday and get them,
Mhm.
today, or I could have called them yesterday. It doesn't matter. Like they're always available to us. So they had really good values that meshed with ours, which was the most important thing to me. I got to take all the advantages of the broker model too, and marry it to the retail model, which I've never had the pleasure of doing. So I got to take my margins and all the things that kept me ultra competitive as a broker and use them in the retail world. Okay, that's the first thing. Second thing is I got to create an appraisal panel. So I got to handpick appraisers, which I even sought your advice on,
Yes, sir.
and you gave me some great names that I knew. So I got to create my own appraisal panel, and then we have dedicated underwriting and processing, and we have our own dedicated closing team. So the opportunities for us to close quickly, efficiently, and not have issues with documents at the last second. If I have an issue with an underwriter or the way that a loan was looked at, I can call and actually speak to a person versus just having to go through an account executive, which was very painstaking for me. And not having that control freaked me out. It made it very stressful for me.
Yeah, I get it.
And
And
nobody
two,
cares. And nobody cares, honestly. Like they're like, you're a loan number. Like we don't care. We have millions of loans coming in. Nobody cares.
I think the way that this
Um,
translates to the consuming public, the benefit, one of the primary benefits that the consuming public would have on the new model and the things you've just discussed is it relates like this. There's nothing worse in the course of the deal than surprises. And there's nothing
no.
worse than surprises coming from, say, an underwriter or, something that's totally unexpected. Or, maybe there is an expected, sort of protocol through the underwriting process. But when you have different ones and a lack of consistency, then surprises occur.
Yes.
But when you know exactly what's going to happen, what your underwriters are looking for, you are greater prepared. You and your LOs at your company are greater prepared because they know what your underwriters are looking for. They know the process, and
Yes.
they can get ahead of that and provide all the resources and documentation that the underwriters are looking for to make their judgments and do their work. And it just makes the whole process quicker, more efficient, easier. You can set expectations with clients much easier and exceed those much better. And it takes that surprise element out of the underwriting process, which can be very, very stressful. And the way it becomes stressful for the consuming public is it happens like this, folks. You're buying a house. You got a closing date that's set. You've invited family to come help you. You've called up moving trucks.
Mhm.
Your whole world is planned around this date that's on the contract, and everybody's expecting it. And then 5 days out, the underwriter comes back and says, you know what? We're going to need this thing and this thing and this thing because, we weren't expecting it and nobody else is, but we need it now. Oh, and by the way, we're not going to be able to process this quick enough. So we're going to have to push that closing date from Friday to the following Tuesday. So all that family that got scheduled to help you move and those moving trucks and all that, it's all got to be rearranged. The days off that you took off of work preparing for this, it's all got to be fixed now. That's the stress that this
Yes.
inconsistent process could
Now,
cause.
if I could just interject for 1 second, though,
Please
in
do.
my company, and you do business with us all the time, we never really saw that with your clients or any of our other clients, right? But those things would come up, and then I would have to handle that. So then nobody ever saw it over stuff that should have never existed or a condition in the first place. So the stress of that, just over the last 2 years of this, like, hey, but wait, there's one more thing. Just honestly, it got to me, and I was just like, I can't. I gotta get a fix for this, because it was consistent. You're right, and the reason it would happen is just because I would always get, when you're a broker, you get to choose from all these lenders, right, that have their advantages, and you would just get different underwriters on every deal. But
Yep.
now that's all changed. Now we have like a designated team that handles all of our deals. We have a designated appraisal panel that handles all of our appraisals that we're still not allowed to know who it goes to and all of that. And we're all compliant, but still we know it's with trusted hands on both sides. And then we also have designated processors on every single loan. So in my
And
team,
real
it's
quick, Jay,
it's amazing.
why
Yeah,
that stuff is important, folks, is having these designated people means that Jay and his crew have the ability to create a relationship with them,
exactly
a
right.
strong relationship with them. And so I'm going to be honest with you, folks. The underwriters, they still don't care. They don't know you. They don't have to look you
No.
in the eyes and explain their decision making, but they do have to look Jay in the eyes and explain their decision making. They do get to know Jay, and they care about their relationship with Jay and his loan officers, which makes all the difference for you guys at
Yep.
the end of the deal.
It does. So just having the same team involved, having the same people involved, we actually get a working relationship going, which to me at the end of the day,
At the end of the day, he freezes up. We made it through 25 minutes without a technical difficulty this time, Jay Slone. I'll tell you what, brother, you will be back on. I've lost. Oh, wait, you there?
yeah, I'm there. It like blipped out for a second, but I'm back.
You said at the end of the
Could you hear
day,
me?
and then we froze.
Yeah, at the end of the day, though, our average closing time so far, we've closed 10 transactions so far in our transition. And every clear to close has been almost a week ahead of our actual closing date. And our average start to finish and from submission to closing is 14 days, not business days for clear to close.
That is meeting and exceeding expectations, no doubt about it.
Absolutely.
Jay, my man, our time is up. I'm going to run into the stats here. As always, dude, I appreciate you coming on Real Estate Bites and dropping wisdom and knowledge and talking about these things that are important, man. These things have an impact on the consuming public, and they need to be aware about it. So you and I are going to get together soon and talk some deeper shop stuff, and I look forward to it, my friend.
Sure.
So until then, thanks,
All
Jay.
right.
Thanks for coming on again.
You got it. Thanks for having me. Have
right,
a great weekend. Bye.
You too, sir. Bye-bye. All right. Very good. So again, thanks to Jay for giving me his time. He always, brings great knowledge about the marketplace, about what's going on in the mortgage world. And, it's no thing to just, when he's trying to run a business and operate a business and just to give up an hour of time. I mean, there was a half hour that we are on and, there's the prep time around it, et cetera. So always appreciative of your time, Mr. Slone. Thank you very, very much. Now let's get into last week's stats. All right. So here we go. And we are looking at, there we go. So we're looking at the statistics for homes sold this past week in Lorain County. Took the last 2 weeks off the show, but I still maintain those statistics so that we can keep this continuity. These stats all come from the MLS. I'm looking at single family homes and condos. I am not looking at multifamily or mobile manufactured homes. So there were this morning 502 homes and condos for sale in Lorain County. Last week, there were 81 homes closed. The median square feet of those homes were 1,733 square feet. Median sale price was $289,900. Again, we use median instead of averages because in averages, you take all of the sales. In median, you take the middle of the pack. That eliminates the outliers that can skew data and gives you a more accurate look at what a typical home sale looks like. Median square foot value, $170.75. The median days on market was 34. So you can see we jumped up there. Home sat a little bit longer on the market before coming off. That is a trend that I'm seeing with my listings here. So 6.22% was the interest rate this morning when I looked at the conventional 30-year note. As you saw, Jay used 6.25% in his math for the monthly payment, talking about the difference between the 30 and the 50-year mortgage. So right on the money there. And the big sale of the week last week was in Avon Lake, $700,000. Let's take a look at that house. So if you live in Bridgeside or are familiar with Bridgeside, this style of home and this layout is going to be very, very familiar to you. But this beauty sold here. This was at $700,000 in Avon Lake. And take a look at some of the features of this $700,000 home. Okay. I want to say this was about 2,300 square feet. I don't know why this has been giving me so much grief with these photos lately, but it has been. And it looks like it's giving me more grief with photos there. So let's just take a look through and you can see some of these pics. Beautiful trade ceilings in the study, in the dining room. Nice. This is the feature, the living room that climbs up to the loft that is sort of featured there in Bridgeside and the homes I've sold there. Nevertheless, let's see if this floor plan comes up or if it's going to give me a hard time. Whatever. That's annoying. So we are going to stop sharing that, and we're going to wrap up Real Estate Bites for the week. Thank you guys for joining me. Listen, if this program is enjoyable, if you get good information from it, click this QR code here right up above my finger and subscribe to the YouTube channel where you can find every episode and share it with friends and family who are interested in this information. Thank you guys for joining me. Thank you for sticking around. As always, take care of yourselves. Take care of one another. I love you people.